This is a technical analysis comprehensive course that you can use for trading stocks, cryptocurrencies, futures, options. We will cover the following in the next few hours. Support and resistance. A support level is a price level where the price tends to find support as it is going down. This means the price is more likely to bounce off this level rather than break through it. However, once the price is past this level by an amount exceeding some noise, it is likely to continue dropping until it finds another support level. A resistance level is the opposite of a support level. It is where the price tends to find resistance as it is going up. This means the price is more likely to bounce off this level rather than break through it. However, once the price has passed this level by an amount exceeding some noise, it is likely that it will continue rising until it finds another resistance level. Reactive versus proactive support and resistance. Most traders will be aware of the many different types of support and resistance methods used by traders. Proactive support and resistance methods are predictive. They often outline areas where price has not actually been. They are formed based upon current price action that through analysis has been shown to be predictive of future price action. Proactive support and resistance methods include Elliott wave, Fibonacci, calculated pivots, trend lines and moving averages. VWAP, market profile. Reactive support and resistance are the opposite. They are formed directly as a result of price action or volume behavior. They include volume profile, price swing lows, highs, initial balance, open gaps and OHLC. Both proactive and reactive support and resistance methods have merit and form a staple part of any support and resistance-based trading strategy. Support and resistance levels can be identified by trend lines. Some traders believe in using pivot point calculations. The more often a support/resistance level is tested, the more significance given to that specific level. If a price breaks past a support level, that support level often becomes a new resistance level. The opposite is true as well. If price breaks a resistance level, it will often find support at that level in the future. Various methods of determining support and resistance exist. A price histogram is useful in showing at what price a market has spent more relative time. Psychological levels near round numbers often serve as support and resistance. Support and resistance levels can be identified by trend lines. Some traders believe in using pivot point calculations. The more often a support resistance level is tested, touched, and bounced off by price, the more significance given to that specific level. If a price breaks past a support level, that support level often becomes a new resistance level. The opposite is true as well. If price breaks a resistance level, it will often find support at that level in the future. Various methods of determining support and resistance exist. A price histogram is useful in showing at what price a market has spent more relative time. Psychological levels near round numbers often serve as support and resistance. More recently, volatility has been used to calculate potential support and resistance. Support and resistance levels can be identified by trend lines. Some traders believe in using pivot point calculations. The more often a support/resistance level is tested, the more significance given to that specific level. If a price breaks past a support level, that support level often becomes a new resistance level. The opposite is true as well. If price breaks a resistance level, it will often find support at that level in the future. Various methods of determining support and resistance exist. A price histogram is useful in showing at what price a market has spent more relative time. Psychological levels near round numbers often serve as support and resistance. More recently, volatility has been used to calculate potential support and resistance using support and resistance levels. If a stock price is moving between support and resistance levels, then a basic investment strategy commonly used by traders is to buy a stock at support and sell at resistance, then short at resistance and cover the short at support. When judging entry and exit investment timing using support or resistance levels, it is important to choose a chart based on a price interval period that aligns with your trading strategy time frame. Short-term traders tend to use charts based on interval periods such as 1 minute, with longer-term traders using price charts based on hourly, daily, weekly, or monthly interval periods. Typically, traders use shorter-term interval charts when making a final decisions on when to invest, such as the following example. Based on 1 week of historical data with price plotted every trend line. Technical analysis. A trend line is formed when you can draw a diagonal line between 2 or more price pivot points. They are commonly used to judge entry and exit investment timing when trading securities. It can also be referred to a Dutch line as it was first used in Holland. A trend line is a bounding line for the price movement of a security. A support trend line is formed when a security's price decreases and then rebounds at a pivot point that aligns with at least 2 previous support pivot points. Similarly, a resistance trend line is formed when a security's price increases and then rebounds at a pivot point that aligns with at least 2 previous resistance pivot points. The following chart provides an example of support and resistance trend lines. Trend lines are a simple and widely used technical analysis approach to judging entry and exit investment timing. To establish a trend line, historical data typically presented in the format of a chart such as the above. Price chart is required. Historically, trend lines have been drawn by hand on paper charts, but it is now more common to use charting software that enables trend lines to be drawn on computer-based charts. There are some charting software that will automatically generate trend lines. However, most traders prefer to draw their own trend lines. When establishing trend lines, it is important to choose a chart based on a price interval period that aligns with your trading strategy. Short-term traders tend to use charts based on interval periods, such as 1 minute, with longer-term traders using price charts based on hourly, daily, weekly, and monthly interval periods. Trend lines are typically used with price charts, however they can also be used with a range of technical analysis charts such as MACD and RSI. Trend lines can be used to identify positive and negative trending charts, whereby a positive trending chart forms an upslipping line when the support and the resistance pivots points are aligned, and a negative trending chart forms a downslipping line when the support and resistance pivot points are aligned. Trend lines are used in many ways by traders. If a stock price is moving between support and resistance trend lines, then a basic investment strategy commonly used by traders is to buy a stock at support and sell at resistance, then short at resistance and cover the short at support. The logic behind this is that when the price returns to an existing principal trend line, it may be an opportunity to open new positions in the direction of the trend, in the belief that the trend line will hold and the trend will continue further. A second way is that when price action breaks through the principal trend line of an existing trend, it is evidence that the trend may be going to fail, and a trader may consider trading in the opposite direction to the existing trend, or exiting positions in the direction of the trend. Breakout. A breakout is when prices pass through and stay through an area of support or resistance. On the technical analysis chart, a breakout occurs when price of a stock or commodity exits an area pattern. Market trend. Market trend is a putative tendency of a financial market to move in a particular direction over time. These trends are classified as secular for long time frames, primary for medium time frames, and secondary lasting short times. Traders identify market trends using technical analysis, a framework which characterizes market trends as a predictable price response of the market at levels of price support and price resistance varying over time. The terms bull market and bear market describe upward and downward market trends, respectively, and can be used to describe either the market as a whole or specific sectors and securities. Secular market trend is a long-term trend that lasts 5 to 25 years and consists of a series of sequential primary trends. A secular bear market consists of smaller bull markets and larger bear markets. A secular bull market consists of larger bull markets and smaller bear markets. In a secular bull market, the prevailing trend is bullish or upward moving. The United States stock market was described as being in a secular bull market from about 1983 to 2000, with brief upsets including the crash of 1987 and the dot-com bust of 2012. In a secular bear market, the prevailing trend is bearish or downward moving. An example of a secular bear market was seen in gold during the period between January 1980 to June 1999, culminating with the brown bottom. During this period, the nominal gold price fell from a high of $850 divided by Oz to a low of $253 divided by Oz, and became part secular market trend of the Great Commodities Depression. Secondary market trend. Secondary trends are short-term changes in price direction within a primary trend. The duration is a few weeks or a few months. One type of secondary market trend is called a market correction. A correction is a short-term price decline of 5% to 20% or so. A correction is a downward movement that is not large enough to be a bear market. Another type of secondary trend is called a bear market rally, which consists of a market price increase of 10% to 20%. A bear market rally is an upward movement that is not large enough to be a bull market X. Bear market rallies occurred in the Dow Jones Index after the 1929 stock market crash, leading down to the market bottom in 1932 and throughout the late 1960s and early 1970s. The Japanese Nikkei 225 has been typified by a number of bear market rallies since the late 1980s while experiencing an overall long-term downward trend. Primary market trend. A primary trend has broad support throughout the entire market and lasts for a year or more. Bull market. A bull market is associated with increasing investor confidence and increased investing in anticipation of future price increases. A bullish trend in the stock market often begins before the general economy shows clear signs of recovery. It is a win-win situation for the investors. India's Bombay Stock Exchange Index, SENSEX, was in a bull market trend for about 5 years from April 2003 to January 2008 as it increased from 2,900 points to 21,000 points. A notable bull market was in the 1990s and most of the 1980s when the US and many other stock markets rose. The end of this time period sees the dot-com bubble. Bear market. A bear market is a general decline in the stock market over a period of time. It is a transition from high investor optimism to widespread investor fear and pessimism. According to the Vanguard Group, while there's no agreed-upon definition of a bear market, one generally accepted measure is a price decline of 20% or more over at least a 2-month period. It is sometimes referred to as the heifer market due to the paradox with the above. Subject. Examples. A bear market followed the Wall Street crash of 1929 and erased 89% of the Dow Jones Industrial Average market capitalization by July 1932, marking the start of the Great Depression. After regaining nearly 50% of its losses, a longer bear market from 1937 to 1942 occurred in which the market was again cut in half. Another, long-term bear market occurred from about 1973 to 1982, encompassing the 1970s energy crisis and the high unemployment of the early 1980s. Yet another bear market occurred between March 2000 and October 2002. The most recent example occurred between October 2007 and March 2009. Market top. A market top is usually not a dramatic event. The market has simply reached the highest point that it will for some time. It is retroactively defined as market participants are not aware of it as it happens. A decline then follows, usually gradually at first and later with more rapidity. William J. O'Neill and Company report that since the 1950s a market top is characterized by 3 to 5 distribution days in a major market index occurring within a relatively short period of time. Distribution is a decline in price with higher volume than the preceding session. Examples. The peak of the dot-com bubble occurred on March 24, 2000. The index closed at 4,704.73 and has not since returned to that level. The Nasdaq peaked at 5,132.50 and the S&P 500 at 1,525.20. A recent peak for the broad U.S. market was October 9, 2007. The S&P 500 index closed at 1,576 and the Nasdaq at 2,861.50. Market bottom. A market bottom is a trend reversal, the end of a market downturn, and precedes the beginning of an upward moving trend. It is very difficult to identify a bottom while it is occurring. The upturn following a decline is often short-lived and prices might resume their decline. This would bring a loss for the investor who purchased stock during a misperceived or false market bottom. Baron Rothschild is said to have advised that the best time to buy is when there is blood in the streets, i.e., when the markets have fallen drastically and investor sentiment is extremely negative. Examples. Some examples of market bottoms in terms of the closing values of the Dow Jones Industrial Average include: the Dow Jones Industrial Average hit a bottom at 1,738.74 on the 19th of October 1987 as a result of the decline from 2,722.41 on the 25th of August 1987. This day was called Black Monday. A bottom of 7,286.27 was reached on the DJIA on the 9th of October 2002 as a result of the decline from 11,722.98 on 14 January 2000. This included an intermediate bottom of 8,235.81 on the 21st of September 2001, a 14% change from 10 September, which led to an intermediate top of 10,635.25 on the 19th of March 2002. The tech-heavy Nasdaq fell a more precipitous 79% from its 5132 peak to its 1108 bottom. A decline associated with the subprime mortgage crisis starting at 14,164.41 on the 9th of October 2007 and caused a bottom of 6,440.08 on the 9th of March 2009. Investor sentiment. Investor sentiment is a contrarian stock market indicator. By definition, the market balances buyers and sellers, so it's impossible to literally have more buyers than sellers or vice versa, although that is a common expression. The market comprises investors and traders. The investors may Own a stock for many years, traders put on a position for several weeks down to seconds. Generally, the investors follow a buy low sell high strategy. Traders attempt to fade the investors' actions buy. When they are selling, sell when they are buying. A surge in demand from investors lifts the traders' asks, while a surge in supply hits the traders' bids. When a high proportion of investors express a bearish sentiment, some analysts consider it to be a strong signal that a market bottom may be near. The predictive capability of such a signal is thought to be highest when investor sentiment reaches extreme values. Indicators that measure investor sentiment may include Investor Intelligence Sentiment Index. If the bull-bear spread is close to a historic low, it may signal a bottom. Typically, the number of bears surveyed would exceed the number of bulls. However, if the number of bulls is at an extreme high and the number of bears is at an extreme low, historically, a market top may have occurred or is close to occurring. This contrarian measure is more reliable for its coincidental timing at market lows than tops. American Association of Individual Investors Sentiment Indicator. Many feel that the majority of the decline has already occurred once this indicator gives a reading of -15% or below. Other sentiment indicators include the Nova-Ursa ratio, the short interest, total market float, and the put-call ratio. Market capitulation. Market capitulation refers to the threshold reached after a severe fall in the market, when large numbers of investors can no longer tolerate the financial losses incurred. These investors then capitulate and sell in panic, or find that their preset sell stops have been triggered, thereby automatically liquidating their holdings in a given stock. This may trigger a further decline in the stock's price if not already anticipated by the market. Margin calls and mutual fund and hedge fund redemptions significantly contribute to capitulations. The contrarians consider a capitulation a sign of a possible bottom in prices. This is because almost everyone who wanted to sell stock has already done so, leaving the buyers in the market, and they are expected to drive the prices up. The peak in volume may precede an actual bottom. Changes with consumer behavior. Market trends are fluctuated on the demographics and technology. In a microeconomical view, the current state of consumer trust in spending will vary the circulation of currency. In a microeconomical view, demographics within a market will change the advancement of businesses and companies. With the introduction of the internet, consumers have access to different vendors as well as substitute products and services, changing the direction of which a market will go. Despite that it is believed that market trends follow one direction over a matter of time, there are many different factors that can change this idea. Technology S-curves, explained in the book The Innovator's Dilemma, states that technology will start slow then increase in users once better understood but level off once another technology replaces it, proving that change in the market is actually consistent. The precise origin of the phrases bull market and bear market are obscure. The Oxford English Dictionary cites an 1891 use of the term bull market. In French, bull speculative refers to a speculative market bubble. The Online Etymology Dictionary relates the word bull to inflate, swell, and dates its stock market connotation to 1714. One hypothetical etymology points to London bearskin jobbers, who would sell bearskins before the bears had actually been caught, in contradiction of the proverb Ni vendes pas la peau de l'ours avant de l'avoir tué, an admonition against over-optimism. By the time of the South Sea Bubble of 1721, the bear was also associated with short selling. Jobbers would sell bearskins they did not own in anticipation of falling prices, which would enable them to buy them later for an additional profit. Another plausible origin is from the word bulla, which means bill or contract. When a market is rising, holders of contracts for future delivery of a commodity see the value of their contract increase. However, in a falling market, the counterparties, the bearers of the commodity to be delivered, win because they have locked in a future delivery price that is higher than the current price. Some analogies that have been used as mnemonic devices. Bull is short for bully in its now mostly obsolete meaning of excellent. It relates to the common use of these animals in blood sport, i.e., bear baiting and bull baiting. It refers to the way that the animals attack. A bull attacks upwards with its horns, while a bear swipes downwards with its paws. It relates to the speed of the animals. Bulls usually charge at very high speed, whereas bears normally are thought of as lazy and cautious movers, a misconception because a bear, under the right conditions, can outrun a horse. They were originally used in reference to two old merchant banking families, the Barings and the Bulstrodes. Bears hibernate, while bulls do not. The word bull plays off the market's returns being full, whereas bear alludes to the market's returns being bear. In describing financial market behavior, the largest group of market participants is often referred to, metaphorically, as the herd. This is especially relevant to participants in bull markets since bulls are herding animals. A bull market is also sometimes described as a bull run. Dow theory attempts to describe the character of these market movements. International sculpture team Mark and Diane Weisbeck were chosen to redesign Wall Street's bull market. Their winning sculpture, the bull market rocket, was chosen as the modern 21st century symbol of the uptrending bull market. The concept of market trends is inconsistent with the standard academic view of the price movement of the financial markets. The efficient market hypothesis. Dead cat bounce. Dead cat bounce is a Wall Street term that refers to a small, brief recovery in the price of a declining stock. History. The term dead cat bounce is derived from the idea that even a dead cat will bounce if it falls from a great height. The phrase has been used on Wall Street for many years. The earliest use of the phrase dates from 1985, when the Singaporean and Malaysian stock markets bounced back after a hard fall during the recession of that year. Journalist Christopher Sherwell of the Financial Times reported a stockbroker as saying the market rise was a dead cat bounce. A similar expression has an older history in Cantonese, and this may be the origin of the term. Variations and usage. A short rise in price followed by a price decline of a stock is the standard usage of the term. In other instances, the term is used exclusively to refer to securities or stocks that are considered to be of low value. First, the securities have poor past performance. Second, there is no indication of an impending rise in price. Lastly, there is no indication that sustained growth is imminent should a major upward shift occur in the market. Some variations on the definition of the term include: a stock in a severe decline has a sharp bounce off the lows, a small upward price movement in a bear market after which the market continues to fall. Technical analysis. A dead cat bounce price pattern may be considered part of the technical analysis method of stock trading. Price patterns such as the dead cat bounce are recognized only with hindsight. Technical analysis describes a dead cat bounce as a continuation pattern that looks in the beginning like a reversal pattern. It begins with a downward move, followed by a significant price retracement. The price fails to continue upward and instead falls again downwards, and exceeds the prior low. The term has also been used in reference to political polling numbers. Elliott wave principle. The Elliott wave principle is a form of technical analysis that traders use to analyze financial market cycles and forecast market trends by identifying extremes in investor psychology, highs and lows in prices, and other collective factors. Ralph Nelson Elliott, a professional accountant, discovered the underlying social principles and developed the analytical tools in the 1930s. He proposed that market prices unfold in specific patterns, which practitioners today call Elliott waves or simply waves. Elliott published his theory of market behavior in the book The Wave Principle in 1938, summarized it in a series of articles in Financial World magazine in 1939, and covered it most comprehensively in his final major work, Nature's Laws, The Secret of the Universe, in 1946. Elliott stated that because man is subject to rhythmical procedure, calculations having to do with his activities can be projected far into the future with a justification and certainty heretofore unattainable. The Elliott wave principle posits that collective investor psychology or crowd psychology moves between optimism and pessimism in natural sequences. These mood swings create patterns evidenced in the price movements of markets at every degree of trend or time scale. In Elliott's model, market prices alternate between an impulsive or motive phase and a corrective phase on all time scales of trend, as the illustration shows. Impulses are always subdivided into a set of 5 lower degree waves, alternating again between motive and corrective character, so that waves 1, 3, and 5 are impulses, and waves 2 and 4 are smaller retraces of waves 1 and 3. Corrective waves subdivide into 3 smaller degree waves starting with a 5 wave counter trend impulse, a retrace, and another impulse. In a bear market, the dominant trend is downward, so the pattern is reversed, 5 waves down and 3 up. Motive waves always move with the trend, while corrective waves move against it. Degree. The patterns link to form 5 and 3 wave structures which themselves underlie self-similar wave structures of increasing size or higher degree. Note the lowermost of the 3 idealized cycles. In the first small 5 wave sequence, waves 1, 3, and 5 are motive, while waves 2 and 4 are corrective. This signals that the movement of the wave 1 degree higher is upward. It also signals the start of the first small 3-wave corrective sequence. After the initial 5 waves up and 3 waves down, the sequence begins again and the self-similar fractal geometry begins to unfold according to the 5 and 3-wave structure which it underlies 1 degree higher. The completed motive pattern includes 89 waves, followed by a completed corrective pattern of 55 waves. Each degree of a pattern in a financial market has a name. Practitioners use symbols for each wave to indicate both function and degree, numbers for motive waves, letters for corrective waves shown in the highest of the three. Idealized series of wave structures or degrees. Degrees are relative. They are defined by form, not by absolute size or duration. Waves of the same degree may be of very different size and or duration. The classification of a wave at any particular degree can vary, though practitioners generally agree on the standard. Order of degrees: grand supercycle, multi-century; supercycle, multi-decade; cycle, 1 year to several years; primary, a few months to a couple of years; intermediate, weeks to months; minor, weeks; minute, days; minute, hours; subminute, minutes. Elliott wave personality and characteristics. Elliott wave analysts hold that each individual wave has its own signature or characteristic, which typically reflects the psychology of the moment. Understanding those personalities is key to the application of the wave principle. They are defined below. Definitions assume a bull market in equities. The characteristics apply. In reverse and bear markets. 5-wave pattern. Wave 1. Wave 1 is rarely obvious at its inception. When the first wave of a new bull market begins, the fundamental news is almost universally negative. The previous trend is considered still strongly in force. Fundamental analysts continue to revise their earnings estimates lower. The economy probably does not look strong. Sentiment surveys are decidedly bearish. Put options are in vogue and implied volatility in the options market is high. Volume might increase a bit as prices rise, but not by enough to alert many technical analysts. Wave 2. Wave 2 corrects Wave 1, but can never extend beyond the starting point of Wave 1. Typically, the news is still bad. As prices retest the prior low, bearish sentiment quickly builds, and the crowd haughtily reminds all that the bear market is still deeply ensconced. Still, some positive signs appear for those who are looking. Volume should be lower during Wave 2 than during Wave 1. Prices usually do not retrace more than 61.8% of the Wave 1 gains, and prices should fall in a 3-wave pattern. Wave 2. Wave 2 corrects Wave 1, but can never extend beyond the starting point of Wave 1. Typically, the news is still bad. As prices retest the prior low, bearish sentiment quickly builds, and the crowd haughtily reminds all that the bear market is still deeply ensconced. Still, some positive signs appear for those who are looking. Volume should be lower during Wave 2 than during Wave 1. Prices usually do not retrace more than 61.8% of the Wave 1 gains, and prices should fall in a 3-wave pattern. Wave 3. Wave 3 is usually the largest and most powerful wave in a trend. Although some research suggests that in commodity markets, Wave 5 is the largest, the news is now positive and fundamental analysts start to raise earnings estimates. Prices rise quickly, corrections are short-lived and shallow. Anyone looking to get in on a pullback will likely miss the boat. As Wave 3 starts, the news is probably still bearish, and most market players remain negative, but by Wave 3's midpoint, the crowd will often join the new bullish trend. Wave 3 often extends Wave 1 by a ratio of 1/618 to 1. Wave 4. Wave 4 is typically clearly corrective. Prices may meander sideways for an extended period, and Wave 4 typically retraces less than 38.2% of Wave 3. The volume is well below than that of Wave 3. This is a good place to buy a pullback if you understand the potential ahead for Wave 5. Still, fourth waves are often frustrating because of their lack of progress in the larger trend. Wave 5. Wave 5 is the final leg in the direction of the dominant trend. The news is almost universally positive and everyone is bullish. Unfortunately, this is when many average investors finally buy in right before the top. Volume is often lower in Wave 5 than in Wave 3, and many momentum indicators start to show divergences. At the end of a major bull market, bears may very well be ridiculed. Recall how forecasts for a top in the stock market during 2000 were received. 3-wave pattern. Wave A corrections are typically harder to identify than impulse moves. In wave of a bear market, the fundamental news is usually still positive. Most analysts see the drop as a correction in a still active bull market. Some technical indicators that accompany wave A include increased volume, rising implied volatility in the options markets, and possibly a turn higher in open interest in related futures markets. Wave B, prices reverse higher, which many see as a resumption of the now long gone bull market. Those familiar with classical technical analysis may see the peak as the right shoulder of a head and shoulders reversal pattern. The volume during Wave B should be lower than in Wave A. By this point, fundamentals are probably no longer improving, but they most likely have not yet turned negative. Wave C, prices move impulsively lower in 5 waves. Volume picks up, and by the third leg of Wave C, almost everyone realizes that a bear market is firmly entrenched. Wave C is typically at least as large as Wave A and often extends to 1.618 times Wave or beyond. pattern recognition and fractals. Elliott's market model relies heavily on looking at price charts. Practitioners study developing trends to distinguish the waves and wave structures and discern what prices may do next. Thus, the application of the wave principle is a form of pattern recognition. The structures Elliott described also meet the common definition of a fractal self-similar patterns appearing at every degree of trend. Elliott wave practitioners say that just as naturally occurring fractals often expand and grow more complex over time, the model shows that collective human psychology develops in natural patterns via buying and selling decisions reflected in market prices. It's as though we are somehow programmed by mathematics. Seashell, galaxy, snowflake, or human, we're all bound by the same order. Elliott wave rules and guidelines. A correct Elliott wave count must observe 3 rules. 1. Wave 2 always retraces less than 100% of wave 1. 2. Wave 3 cannot be the shortest of the 3 impulse waves, namely waves 1, 3, and 5. 3. Wave 4 does not overlap with the price territory of wave 1, except in the rare case of a diagonal triangle. A common guideline observes that in a 5-wave pattern, waves 2 and 4 will often take alternate forms. A sharp move in wave 2, for example, will suggest a mild move in wave 4. Corrective wave patterns unfold in forms known as zigzags, flats, or triangles. In turn, these corrective patterns can come together to form more complex corrections. Fibonacci relationships. R.N. Elliott's analysis of the mathematical properties of waves and patterns eventually led him to conclude that the Fibonacci summation series is the basis of the wave principle. Numbers from the Fibonacci sequence surface repeatedly in Elliott wave structures, including motive waves, a single full cycle, and the completed motive and corrective patterns. Elliott developed his market model before he realized that it reflects the Fibonacci sequence. When I discovered the wave principle action of market trends, I had never heard of either the Fibonacci series or the Pythagorean diagram. The Fibonacci sequence is also closely connected to the golden ratio. Practitioners commonly use this ratio and related ratios to establish support and resistance levels for market waves, namely the price points which help define the parameters of a trend. See Fibonacci retracement. Finance professor Roy Batchelor and researcher Richard Ramyar, a former director of the United Kingdom Society of Technical Analysts and head of UK asset management research at Reuters Lipper, studied whether Fibonacci ratios appear non-randomly in the stock market, as Elliott's model predicts. The researchers said the idea that prices retrace to a Fibonacci ratio or round fraction of the previous trend clearly lacks any scientific rationale. They also said there is no significant difference between the frequencies with which price and time ratios occur in cycles in series. Robert Pritzker replied to the Batchelor Ramyar study, saying that it does not challenge the validity of any aspect of the wave principle. It supports wave theorists' observations, and that because the authors had examined ratios between prices achieved in filtered trends rather than Elliott waves, their method does not address actual claims by wave theorists. The Socionomics Institute also reviewed data in the Batchelor Ramyar study and said these data show Fibonacci ratios do occur more often in the stock market than would be expected in a random environment. Example of the Elliott wave principle and the Fibonacci relationship. After Elliott, following Elliott's death in 1948, other market technicians and financial professionals continued to use the wave principle and provide forecasts to investors. Charles Collins, who had published Elliott's wave principle and helped introduce Elliott's theory to Wall Street, ranked Elliott's contributions to technical analysis on a level with Charles Dow. Hamilton Bolton, founder of the Bank Credit Analyst, provided wave analysis to a wide readership in the 1950s and 1960s. Bolton introduced Elliott's wave principle to A.J. Frost, who provided weekly financial commentary on the Financial News Network in the 1980s. Frost co-authored Elliott wave principle with Robert Pritzker in 1978. Rediscovery and current use. Robert Pritzker came across Elliott's works while working as a market technician at Merrill Lynch. His prominence as a forecaster during the bull market of the 1980s brought the greatest exposure to date to Elliott's work, and today, Pritzker remains the most widely known Elliott analyst. Among market technicians, wave analysis is widely accepted as a component of their trade. Elliott's wave principle is among the methods included on the exam that analysts must pass to earn the Chartered Market Technician designation, the professional accreditation developed by the Market Technicians Association. Robin Wilkin, ex-global head of FX and commodity technical strategy at J.P. Morgan Chase, says the Elliott wave principle provides a probability framework as to when to enter a particular market and where to get out, whether for a profit or a loss. Jordan Kotick, Global Head of Technical Strategy at Barclays Capital and past President of the Market Technicians Association, has said that R.N. Elliott's discovery was well ahead of its time. In fact, over the last decade or two, many prominent academics have embraced Elliott's idea and have been aggressively advocating the existence of financial market fractals. One such academic is the physicist Didier Sornet, visiting professor at the Department of Earth and Space Science and the Institute of Geophysics and Planetary Physics at UCLA. In a paper he co-authored in 1996, Stock Market Crashes, Precursors and Replicas, Sornet said, "It is intriguing that the log periodic structures documented here bear some similarity with the Elliott waves of technical analysis. A lot of effort has been developed in finance both by academic and trading institutions, and more recently by physicists using some of their statistical tools developed to deal with complex times series to analyze past data to get information on the future. The Elliott wave technique is probably the most famous in this field. We speculate that the Elliott waves, so strongly rooted in the financial analysts' folklore, could be a signature of an underlying critical structure of the stock market." Paul Tudor Jones, the billionaire commodity trader, calls Pritzker and Frost's standard text on Elliott a classic and one of the four Bibles of the business. Technical analysis of stock trends and the Elliott wave theorists both give very specific and systematic ways to approach developing great reward-risk ratios for entering into a business contract with the marketplace, which is what every trade should be if properly and thoughtfully executed. The premise that markets unfold in recognizable patterns contradicts the efficient market hypothesis, which states that prices cannot be predicted from market data such as moving averages and volume. By this reasoning, if successful market forecasts were possible, investors would buy when the method predicted a price increase, to the point that prices would rise immediately, thus destroying the profitability and predictive power of the method. In efficient markets, knowledge of the Elliott wave principle among traders would lead to the disappearance of the very patterns they tried to anticipate, rendering the method and all forms of technical analysis useless. Benoit Mandelbrot has questioned whether Elliott waves can predict financial markets, but wave prediction is a very uncertain business. It is an art to which the subjective judgment of the chartists matters more than the objective, replicable verdict of the numbers. The record of this, as of most technical analysis, is at best mixed. Robert Pritzker had previously stated that ideas in an article by Mandelbrot originated with Ralph Nelson Elliott, who put them forth more comprehensively and more accurately with respect to real-world markets in his 1938 book The Wave Principle. Critics also warn the wave principle is too vague to be useful, since it cannot consistently identify when a wave begins or ends, and that Elliott wave forecasts are prone to subjective revision. Some who advocate technical analysis of markets have questioned the value of Elliott wave analysis. Technical analyst David Aronson wrote, "The Elliott wave principle, as popularly practiced, is not a legitimate theory, but a story, and a compelling one, that is eloquently told by Robert Pritzker. The account is especially persuasive because EWP has the seemingly remarkable ability to fit any segment of market history down to its most minute fluctuations. I contend this is made possible by the method's loosely defined rules and the ability to postulate a large number of nested waves of varying magnitude. This gives the Elliott analyst the same freedom and flexibility that allowed pre-Copernican astronomers to explain all observed planet movements even though their underlying theory of an Earth-centered universe was wrong." This is Crypto Block IQ. Subscribe to this channel to get the latest price analysis and trading systems signals. We focus on LUNC News Today, Terra Luna Classic News Today, Luna Classic Price Prediction. Also, we present analysis on Bitcoin and Bitcoin News Today. We cover tickers XRP, BTC, Cardano, ETH technical analysis, and BNB Hive. We also going to add explanations on topics such as how to stake Luna Classic and BNB Miner works. Our videos cover BTC technical analysis, Luna Classic price prediction, Binance USC analysis, and more. Metin 2F. In the next weeks, we will add VeChain live news in our videos and Ethereum mainnet details. Write down below in the comments what is your strategy for the next few days. Click the card on the right to get to more price prediction and technical analysis videos.